Morning. This is Brandy Twilliger, partner over here at Costerisan. So today we're going to talk a little bit about unrelated business income and whether or not you have it and how to know if you have it. So today's agenda, on session 1, we're going to talk about an overview of what makes up UBI, and we're also going to talk about some common sources of UBI and what to look out for. Next Thursday at 11:30, I'm going to go back in, and once you've determined that you do have unrelated business income, we'll talk a little bit about the expenses that you can deduct from that income to lower your tax and how to allocate those expenses. We'll also talk about some of the logistics of the Form 990T. I know a lot of the people on this webinar today are clients, so we probably prepare your 990T, but this way, when you're talking and going over the form with your board of directors, you'll have a little bit more understanding on what makes up that form and how it's reported. And then I'll have a few resources available at that time. So hopefully we'll be able to see most of you next Thursday also at 11:30. So first I want to start talking about the actual law of what unrelated trade or business is. And so really what I'm showing here is just the general rule. There's a lot to this law, and there's a lot of exceptions and different things that go along within the law, but the broad term of unrelated trade or business means that in the case of any organization subject to the tax imposed by Section 511, any trade or business, the conduct of which is not substantially related. And when I talk about any trade or business, I'm actually going to go through a 3 kind of pronged test, and one of them talks about how you know if it's a trade or business. And then next it says, aside from the need of such organization for income or funds, or the use it makes of the profits derived. So what this is saying is that it really doesn't matter if you need the money for your exempt purpose or what you're spending the money on. The IRS only cares about how you've received that money. So the reasoning behind that is if your revenue stream could potentially be in competition with another for-profit like business that is paying tax on that type of activity. So that's why they're only looking at how you're receiving the revenue. On this slide, it shows the 3 prongs, and I kind of like to look at it as a 3-legged stool. And as I go through these, you'll find that if you kick one leg out of that stool, then you're okay. You don't have UBI. It really has to meet all 3 of these different legs, I guess, or prongs. So it has to be a trade or business, has to be unrelated to your exempt purpose, and it has to be regularly carried on. So at this point, whenever you have a new revenue stream, or even if you want to go back and look at some of the other revenue streams that you have, you'll want to run them through this test to see, if they're really related to your exempt org or if they could potentially be UBI. And then you're always going to want to document those that are, if it's clearly related to your exempt purpose, then I wouldn't even worry about it. But if there's some question, then it's probably important to run through this test and document what you found. So first we're going to talk about trade or business. And so here the IRS is saying the key point is, do you have a profit motive? What is your intent with this specific activity? And sometimes loss activities could have evidence of a profit motive. A lot of times the IRS will say if you have losses over and over and over again that you don't have a profit motive. But sometimes that profit motive can be legit, and especially if you have a new activity that maybe you are just starting out, just like a new business, and for the first couple of years you have losses, but your intent is to make a profit in the long run. You keep filing so that you can save those losses for future profits in future years. So I wouldn't necessarily not file. We wouldn't not file just because you have a loss, because it may, have an income in future years that you could use that loss against. Currently, the IRS code allows you to offset losses of one activity with gains from another activity. So for example, if you have a limited partnership that you have an interest in, that the organization has an interest in, and that's profitable, and it's causing UBI and creating tax. But you also have an activity where you're providing a management service to a non-related organization, but that's generating a loss. But you can prove that that activity does have a profit motive. So your intent is to make a profit, and maybe some of those things to prove that is that you hired a new manager, or you're advertising to get other organizations that you could manage, unrelated organizations, or you're looking at cost cutting. So you're doing those things that a normal for-profit business would do to make a profit. Then you can use those losses against the revenue of the other activity of the partnership, limited partnership interest. The IRS, there's always that chance the IRS could come in and say and try to prove that you have no profit motive in that one activity, or that you've overextended your expenses, and they may disallow that, which then would cause the other activity to be taxable. There is a proposal in Congress to silo activities where you would not be able to use losses of one activity against gains of another activity. So it's something that we'll keep an eye on. If you're in a situation where that could, affect later, it's a great time to start thinking about planning for that, and we'll keep an eye on whether that goes through Congress. So when you're looking at profit motive also, you're going to want to look at what your position is before taking some deductions like depreciation and charitable contributions. So if you add those back and you have a profit, then it's pretty certain that you can say you have a profit motive. So that's how you kind of pass that test, is whether or not you're in for a profit. The next part of the test is if the activity is regularly carried on. So this is the frequency and continuity of the activity. It's nothing that's just sporadic or infrequent. And it has to be in the context similar to a commercial enterprise. So I have a couple examples that might help understand this test. The first example would be, say you have a golf event, and the brochure that you're handing out at your golf event has advertising, and you're receiving income for that advertising. But that brochure is really only available the day of the outing, maybe a day or two after, and then you throw some on a shelf somewhere, and maybe someone looks at it 6 months from now, but it's really only meant for that day. Well, if you look at that in the context of a normal publication company, then they wouldn't just do a publication once a year. It would be something that's regularly, monthly, quarterly. So in the context of a regular publication company, this is not regularly carried on. So it would probably not be UBI. But on the other hand, if you have a local organization in your town, maybe like a Boy Scout organization or something, that is selling Christmas trees, and they sell them during the month of December. Well, in comparison to a for-profit Christmas tree company that sells Christmas trees, they're probably only going to sell them in December. You don't usually see people selling Christmas trees in April. So in the context of selling Christmas trees, this particular activity is regularly carried on in the context of that same commercial enterprise. So that's kind of what that means when we talk about it having to be similar to a commercial enterprise in whatever activity that you're doing. It's kind of the competition thing. You want to make sure you're not in competition with a for-profit entity that is doing the same type of activity. The next part of the test is to make sure that the activity, for it to be UBI, is that it's unrelated to your exempt purpose. So in this case, it does not contribute to your exempt purpose, and there's no substantial causal relationship to the achievement of the exempt purpose. So this test you can get pretty creative with. So even if you've failed the other two tests and you don't want UBI, you could get pretty creative with this test. And so I'll give a couple examples. Like for example, this one, very facts and circumstances. So, and a good example would be a college. And sometimes colleges will buy property right outside their, like the line of their college. And they do this a lot of times because they may want to expand later. And so when a piece of property becomes available, they purchase it. Well, if they have this property and it's just sitting there, but 6 months later they decide to do something with it. They're not ready to expand, but they decide to turn it into a bed and breakfast. When you're first looking at that, you think, well, that's UBI. They have a profit motive. It's regularly carried on, and it's not substantially related to the purpose of educating their students. However, in this example, the college decides that, oh, well, we have a tourism department, and we're going to use this bed and breakfast as a learning lab for our tourism department on how to run a bed and breakfast. And then they decide to get the accounting students involved and do the accounting for it and all the filings, and then they get their marketing students involved and do marketing for the bed and breakfast. Well, all of a sudden now, it's substantially related to the purpose of educating their students and not UBI. So they're able to kick out this test. So that's a really good example of how to kind of be creative when it comes to those types of things that are kind of may be related if you can make them related. The next thing is size and extent of the activities, and how does this relate to being unrelated to the exempt purpose? And an example is if you had the same college, and that college has a farming and agricultural department, and so as part of that department they have 100 dairy cows, and they're do studies on those dairy cows, and the college only needs 100 to actually run the department and provide the service to the students. But the milk from these cows is a natural byproduct. So for that purpose, if they sell that milk, it wouldn't be UBI. However, the college realizes that they're making quite a profit on this milk byproduct. So they decide to add 1,000 more cows to their herd. And even after that, they start taking that milk byproduct and making ice cream and cheese and selling it. Well, at this point, it has now become a large activity and exploited the purpose. So it was expanded outside of what they actually needed to provide the purpose to their students and the education of their students. So at this point, the part that they've exploited now is potentially UBI, unless they can knock out one of the other tests, but for the most part, it's probably going to be UBI. So this is where, the size and extent of the activity comes into play. For dual use property, this is when normally you have a piece of property that you use, for the most part for your exempt purpose, but then sometimes rents it out to unrelated organizations or people. Then we have to look at that and determine if that's UBI. And we'd have to look at those other tests also. So we're going to get into some more common exceptions and exclusions for UBI. So the first one I want to talk about is the first three at the top of the screen: real property, personal property, and services. So many organizations have property that they lease out, rent out to unrelated, or related organizations. And most of the time, rent on real property is not UBI. However, as I have a caution sign over on the other side of the screen, if there is any debt involved in the acquisition or improvement of that property, there is potential UBI. And there's some calculations that are involved in figuring out what portion, and it really has to do with debt, how much debt's left, and things like that. But if there's debt involved, then it's probably UBI. Also, if the lease agreement includes personal property, there could be some UBI that is not excluded. So usually if the agreement has less than 10% personal property, it's pretty de minimis, and usually we can just not report it as UBI. If it gets to be 10 to 50%, then we do start to look at those other tests, and it's probably UBI. If the agreement is over 50% personal property, then a lot of times that just kind of taints the whole thing and it becomes UBI, disregarding the part that's real property. And then also if that lease agreement has services included, and this means like services, not the normal services that a landlord would provide, but if you're providing additional services that are above and beyond what a landlord would provide, then those services are potentially UBI. And obviously, as I say potentially UBI, I always say that because there's other tests. So you want to make sure that you're looking at the three tests. And then now I'm going to talk about interest dividends, royalties, and gains on sales, those passive income. In general, those items are not UBI if received. Unless, like I said, unless there's debt involved in, purchasing the investment that's generating this income. And later on in the slides, I'll talk about when these items, especially interest and royalties, are received from a controlled organization. There's a carve out in the law, and I'll talk about it later, that makes those items taxable to the controlling organization. So I'll talk about those shortly, but for the most part, those items are not UBI. Some other exceptions and exclusions that I'll kind of briefly run through that you may have are the next two slides. So the first one is volunteers. The activity could potentially be excluded if a substantial portion of the activity is run by volunteers. So like I mentioned earlier on that activity that, like the Boy Scouts selling Christmas trees, if most of the activity is being run by parents that are volunteering, a substantial portion of it are volunteering, then we could potentially exclude it from UBI. The thrift shop exclusion, that's for when you're selling donated items. So this would cover like the Goodwill stores, or if you have an auction, a live auction or a silent auction, and those items are all donated, then they could fall under this exception. And then research is if you're being asked, you're getting provided income to do research on some sort of specific topic, and that research is being is going to be available to the general public, then there can be an exclusion for that also. Some of the common things we see are sponsorships. Sponsorships are more like acknowledgments of that, usually a for-profit company or an individual that just wants an acknowledgement of their name. And so that's not UBI. However, it's different from advertising. And advertising is UBI to the extent that there's a call of action. So it's a little bit different when you have a sponsorship versus an advertising ad, within your magazine. So a lot of times we look at those when we're looking at magazines or things that you have out there for your organization members. We look at whether they're a sponsorship or a true advertisement. Public entertainment activities and trade shows. What I see is a lot of times is our trade associations, our 501c6s. They have, trade shows or something like a county fair. Those are excluded from UBI. And then the convenience exception. And I put the words gift shop on here because that's the thing that mainly comes to mind for me when I look at the convenience exception. And it doesn't mean that that's the only time there's a convenience exception, but this example is what I see most. And that's with, for example, like a science museum. And that science museum has a store. Like clearly, most of the items they sell in there are related to science. They're different types of science projects for kids or adults. But in that store, they have another category of items that are there for the convenience of their patrons. For example, bottled water, pop, Tylenol, those types of things. Those items are not related to their exempt function. However, there's a convenience to having them there for the people that are visiting your museum, your science museum or history museum. This doesn't happen very often, but it does not cover those people who may come off the street and aren't there for the science museum, but are coming in and buying things out of your store. I don't know that rarely happens, but usually they've had to pay a fee to get in before they can get to the gift shop. But in the event that's not covered under this exception. We're going to talk a little bit about some potential UBI sources and things that you may run into. And sometimes we find these things out that, some of our clients will have these things, but we don't necessarily know they have, especially K1s. And so it's always important to make sure that you're letting us know if you do have these types of K1s coming through or transactions coming through, so that we can make sure we're reporting them correctly. So in a partnership interest, sometimes, actually in many cases, not-for-profit can have interest in a partnership. And the income from this partnership, interest, dividends, royalties, those types of things are passive income, like I mentioned earlier, and not UBI. However, notice on this screen, it's kind of hard to see, but I tried to squeeze it in there. Line 1 is ordinary business income or loss. And that is usually UBI unless you can prove that it's not unrelated to your organization. And so in most cases, it's not related and it's ordinary income and needs to be reported as UBI on your 990T. Another line to look for is line number 2, that net rental real estate income or loss. Sometimes it's hard to know whether that rental income is related to a debt financed property. Sometimes you get a K1 that's really good and it has footnotes that explain what portion is debt financed, but not always. So in these cases, sometimes we've had to go back and try to contact the CPA who prepared or whoever prepared the K1 and ask them if any of that rental income was from debt financed property. So definitely something to keep an eye on if you have any K1s floating into your organization. And now I'm going to jump into a couple other potential UBI sources. So SCorp Income. If you're receiving a K1 from an SCorp, that is always taxable. It doesn't matter what kind of income it is always taxable. I don't see this very often. Normally it's when someone has interest in an SCorp and they've gifted their interest to a not-for-profit organization. Sometimes we see that. Then management services to an unrelated organization. So you run it through the 3-prong test, but for most cases, this is UBI. I don't really know any organization that would provide management services to an unrelated organization without making a profit, because they're usually focused on their mission. And so usually this is UBI. As I talked about earlier, advertising on periodicals and magazines. Obviously, we would run that through that test, like we mentioned earlier on the golf brochure. In that case, the advertising wasn't regularly carried on. But a lot of our organizations have monthly or quarterly newsletters that go out to their members with advertising in there. And we work with you on how to, report that and get the correct expenses, which I'll talk about next week. And then payments from controlled entities. And this is what I mentioned earlier. So there's a code section in the law, and it's under 512B13, if anybody is interested in IRS code. But this code section says, okay, what the IRS was seeing was they would see a not-for-profit organization that had a wholly owned subsidiary corporation. And a lot of times I see that when they want to start running their, unrelated activities through a corporation instead of their 990T. Because they're related, it was way too easy for the corporation to come up with an amount to pay the not-for-profit organization in interest, royalties, rent, or annuities and drop their taxable income to 0. So the corporation would have 0 taxable income and the not-for-profit would have revenue that's not taxed because these passive activities are usually not UBI. Well, the IRS caught on to that back in about 2006, and they came up with this law that says, okay, if you're getting these type of items from a controlled corporation, they're going to be UBI to the not-for-profit organization. Dividends is not included because dividends are not deductible on the corp anyways, and it's based on to the extent that it reduces the corporation's income or increases their loss. So that's definitely something to look for. I recently had one that had that, and they weren't aware of this law, and so we're working on trying to, see what we can do for them in that area. So I know I've run through that pretty quickly, but I wanted to say, in every time you're getting a new revenue stream, it's really important to kind of look at that. And if it's not clearly related to your exempt purpose, then think about those 3 prongs. Or, you can email me or give me a call here at the office. I'm happy to help work through those types of questions and trying to find some creative ways maybe to get out of the UBI if we can. And if we do have UBI, we'll talk a little bit next week about how to allocate some expenses to that. But, just really look at those and let me know if you ever have any questions. I'm happy to help. Please email me or give me a call at the number on the slide. Thanks and have a great day.